The chip sell-off hitting markets today is not a random correction. It may be the first visible tremor of a structural shift that has been building for 3 years. Amazon just confirmed to CNBC that it is designing its own AI chips specifically for Echo, Fire TV, and future devices. That one sentence should make every investor holding broad semiconductor exposure stop and recalibrate. Because when the largest cloud provider and one of the largest consumer electronics companies decides it no longer wants to buy what the chip industry is selling, who exactly is the customer anymore? Let's establish what is actually happening here, because the framing in most coverage is too narrow. Amazon telling CNBC that it is designing AI chips for Echo and Fire TV is not a product announcement. It is a declaration of strategic independence from merchant silicon, the off-the-shelf chips sold by companies like NVIDIA, Qualcomm, and MediaTek that have historically powered consumer devices. This is not Amazon being first. Apple moved aggressively to custom silicon with the M-series chips starting in 2020, and the performance and margin advantages have been well documented. Google has been running its own tensor processing units inside data centers since 2016 and extended that logic into its Pixel hardware line. Microsoft is now committing $2.5 billion and 6,000 employees to a new AI implementation unit, a signal that the battle is no longer about who has the best model, but who controls the full stack that delivers it. What Amazon is signaling is that AI at the edge, meaning inference running directly on devices in your home rather than in a data center, is now worth the substantial cost of custom chip development. That cost includes years of engineering, manufacturing partnerships, and the risk of execution failure. Companies do not absorb that cost unless the alternative, buying from a third party, has become either too expensive, too slow, or too strategically exposed. The actionable insight here is this: vertical integration in AI silicon is no longer a differentiator. It is becoming the baseline expectation for any platform company with sufficient scale. If you are analyzing semiconductor companies that depend on consumer device design wins, the dependency deserves a harder look than it did 12 months ago. Markets are down today. The Dow, S&P 500, and NASDAQ are all set to open lower as investors wait on the jobs report, and chipmaker stocks are leading the sell-off, according to both MarketWatch and Reuters. The yen is gaining against the dollar. Payroll data is pending. On any given Thursday, you would analyze this as routine macro volatility, rate sensitivity, risk-off positioning, nothing structural. But today is not a routine Thursday, and that framing is worth resisting. Because when you combine a broad chip sell-off with an Amazon executive publicly confirming a custom silicon strategy for consumer devices, you have 2 data points that may be reinforcing the same underlying thesis. The merchant chip model, where device makers simply buy standard processors from a catalog, is under compression from 2 directions simultaneously. Direction 1 is macroeconomic. A strong jobs number could push rate expectations in a direction that pressures growth multiples, and semiconductor stocks carry high multiples because they are priced for continued AI infrastructure spending. That spending is real, but the multiples embed significant optimism. Direction 2 is structural, and it moves slower, but matters more. Every major platform company that builds custom silicon is reducing its addressable purchase volume from merchant suppliers. That does not destroy the semiconductor industry. The underlying manufacturing and IP still flows through it. But it does compress the end market opportunity for companies whose value proposition is selling finished chips to device makers. Here is the distinction that matters for your analysis. Companies that sell chip designs or manufacturing capacity are positioned differently than companies that sell finished AI accelerators into consumer or enterprise device markets. Today's sell-off does not make that distinction. The market rarely does on day one. That gap between market reaction and structural nuance is where informed analysis lives. This is not financial advice. It is a framework for asking better questions before the consensus catches up. Let's zoom out to the pattern, because Amazon's chip announcement and Microsoft's $2.5 billion AI implementation unit are not separate stories. They are the same story told from different angles. Microsoft committing 6,000 employees to a dedicated AI implementation operation tells you that the competitive moat in AI is shifting from model capability to deployment infrastructure. OpenAI simultaneously floating the idea of giving the Trump administration a 5% stake in the AI boom, as reported by The Verge, tells you that regulatory positioning and government relationships are now being treated as strategic assets worth equity. These are not the moves of an industry in its experimental phase. These are the moves of an industry that believes the foundational architecture decisions made in 2026 will determine who controls the next decade of computing margin. For Amazon specifically, designing AI chips for Echo and Fire TV is the consumer edge of a much larger strategy. Amazon Web Services already develops custom AI silicon, the Trainium and Inferentia chip families, for cloud workloads. Extending that capability to consumer devices closes the loop. It means Amazon can run AI inference on its devices using chips it designed, on software it controls, connected to cloud infrastructure it owns. The data flywheel advantage of that architecture is significant and difficult to replicate for companies that do not have all three layers. The question this raises, and the one your investment thesis needs to answer, is which companies are building that full stack position and which are renting pieces of it from others. Renting works until it doesn't. The companies that own the stack have structurally higher ceilings and historically more durable margins once the infrastructure wars resolve. Watch which companies are making capital allocation decisions that point toward ownership rather than licensing. That is the signal worth tracking in the second half of 2026. We opened by asking who the customer is when the largest cloud and device companies start building their own chips. The answer is the customer is shrinking, at least for merchant silicon targeting consumer devices. The structural pressure is real, the macro volatility is amplifying it, and Microsoft's full stack commitment confirms the direction. The follow-up question, which specific semiconductor companies are most exposed to this design win erosion and which actually benefit, that is the next video. Subscribe so you get it the moment it drops.